Ever known anyone who sold their company to a proclaimed fast growth company? Are you thinking about selling your not so fast growth company to a fast growth buyer? Do you even know what fast growth really means in this situation? I mean, did anyone ever really tell you what fast growth really means in this situation? It was probably phrased as something cool, attractive, sexy, hey, we're a fast growth company and we want you to be part of our culture because we think you have untapped potential, right? That's probably what they said, something like that. Unfortunately, what this means is unless you know from experience what it takes to drive 20 to 30% top line growth year over year, you simply don't understand. You think you do, but you don't. And when you find out what it's really like, you may not like it. Good morning and welcome back to Ownership Transition Advisors, where I talk about all the real and practical changes and issues you as the owner will face after you sell your business. And these are all based on my 20 years experience working with companies from across the country after they've been acquired. They're all real situations I've personally experienced, and these happen all the time. So if you own and run a typical small to mid-sized service business, you probably think of growth in 3 or 4 parts, right? One is don't lose business I already have, of course. 2 is, I'm okay adding 4 to 7% revenue each year through maybe an increased service line, new offering, maybe getting into a new territory, price increases, that kind of thing. And the third thing is you want to maintain profit margins during this slow growth period, right? This 4 to 7% growth. So let's say you're a $5 million business and you're running 12% bottom line and your top line's been growing 4, 5, 6, 7% year over year. Solid customer base, solid employees who've helped you build to this point, right? You're making great money, lower risk, work-life balance is in check for all the employees and everybody's happy, right? Okay, now you sell your business to a company who offers you a solid deal and they tie 30% of your payout to a 3-year earnout. They promise tools and training to make your company and your people better, and they talk proudly about them being a fast growth company, which sounds really cool. I mean, how exciting to now be part of a fast growth organization. Well, what they didn't tell you is when buying companies talk about fast growth, they're not talking about 4 to 7% year over year revenue increases. They're talking about 20, 25, 30% year over year revenue increases. And oh, by the way, we also need to get your profit from that 12% to 17, 18, 19 while we're growing that 20 to 30% top line. On paper, it all looks doable, right? They'll explain it to you and you buy into it, right? Now the problem really begins because unless you've actually done this before, you have no idea what it really means or feels like to have the pressure to grow at a 20 to 30% rate. And all of your employees who are accustomed to that, typical 4 to 7% growth rate, they don't have any idea about it either. And 90% of them don't have any interest in that kind of growth. And to be honest with you, most of them are not even capable of doing what's required to achieve that growth. And to make things worse, if your earnout was built on a higher growth rate than you've achieved in recent years, you have a completely different problem right now. So what will you do? Well, after 4 or 5 months, the new owners will start pressuring you to show how you're going to achieve this 20, 30% growth, which means you're going to start pressuring your people to do something they've never done before. And not only have they never done it before, but they don't even know how to do it. The next move that this buyer is going to probably do is they're now going to realize that, okay, you're not going to have that growth rate as quickly as we thought. So now we have to start looking at your employees who are contributing at the appropriate level and identifying those who aren't, right? And guess what? Those who aren't contributing at that expected level are going to find themselves on a cut list, and you're going to start hiring replacements who can operate at that fast growth level. At this point, the culture of your business is something quite different from what you built. You're going to start experiencing employee customer turnover, and by the end of the first 12 to 16 months, you're probably going to wish you'd never sold to this company. You'll miss the first year of your earnout, which creates an emotional wedge between you and the buyer. And pretty soon you're going to find yourself emotionally checking out of the entire deal. So now what happens? Well, you do the best you can, but you've slowly stopped caring that much anymore. Your people see it, and they start questioning their purpose and their roles in the future with the company. The buyer sees this, and they're going to start pushing harder. Eventually, they will start replacing people, and your business will continue its transformation from what it was when you sold it to what you now are becoming. Look, this all sounds a little bit doom and gloom, and it might be, but it's real and it happens. But unless the buyer and the seller are honest with each other in the beginning about what will be expected from the seller and their team, these misunderstandings will grow and they undermine the success of the business for both the seller and the buyer. Look, if this is something you're dealing with, you're thinking about, or you're aware of, and you're interested in learning more about what I'm doing at Ownership Transition Advisors and how I might be able to help you, you can always message me through my website or my LinkedIn profile. The links are always below. And we can usually decide on a 15-minute phone call if it makes sense to work together with what's going on with you in your business right now. So anyway, thanks for watching, and I'll see you on the next video.